Good morning. I'm Tim Nyland. With all of the criticism of mega cap tech stocks these days, today we're going to explore exactly what the S&P 500 Composite ETF would look like without mega cap technology stocks present. Specifically, we are going to look at the 6 earnings certain portfolio macro mega cap tech stocks and their relative weight in the S&P 500 Composite ETF. And then we're going to use the ZRS Composite facility to remove their histories from the S&P 500 and reweight the S&P 500 Composite ETF as if these 6 ECP mega cap tech stocks never existed. We are then going to do a bake-off between the S&P 500 Composite ETF with and without mega cap tech present, looking at comparative average performance, valuation, capital efficiency, estimate revisions, and profit margins. Before we get started, please like, comment, and subscribe, and come back every week for more videos on investing strategy and making the most of Zacks Pro platforms. If you'd like to do the kind of analysis you're going to see in this video, then you need to have a ZAT Portfolio Manager subscription, which includes both Zacks Advisor Tools and the Zacks Research System. Let's go ahead and get started. The very first thing we're going to take a look at is the actual weightings of the top 6, I should say, the top 5 plus Adobe. These are going to be our 6 ECP macro mega cap tilt stocks that we use as a macro tilt sleeve in our earnings certain family of equity model portfolios. This spreadsheet should be very familiar to most if you've watched my webinars historically. About once a month, I go in and monitor exactly what's moving and how the weights are changing within the top holdings of the S&P 500. And what you're going to note today, as we actually move to remove these top 6 names that I have highlighted here with the black box, these are going to be the top 5 mega cap techs, again, plus Adobe. You'll see that that group combined represents almost $9.5 trillion in market cap, and that group represents 23.5% of the S&P 500. Okay, this spreadsheet is a spreadsheet that's compatible with our Z-Link facility out of the Zacks Research System and Advisor Tools. It's the spreadsheet add-in, and this spreadsheet can be made available by request for anyone that wants it. You'll also note here that the bottom 365 names in total market cap equal roughly $9.5 trillion as well. So to state that differently, in the significance of these 6 names that we use in our macro tilt sleeve for the earnings certain family of equity model portfolios is that these 6 mega cap tech names in terms of weight represent the bottom 365 names in total market cap of the S&P 500. Okay, so what we're going to do today is we are going to look at 3 different Zacks Research Systems composites. And the first one we're going to look at is the S&P 500. This is just a straight replication, a straight market-weighted composite of the S&P 500. And we're going to look at that relative to the actual S&P 500 index to validate or to otherwise baseline our methodology for composites to prove to you that our methodology is in fact accurate. The next thing we're going to do is we're going to actually remove these 6 stocks and we're going to reaggregate those up into a new market-weighted composite called the SP5M XT, standing for X tilts. I've went ahead and had our product group, Adam Cohen, make this available to all Zacks Research System subscribers so that you can actually mirror this type of analysis on your own system. And then obviously we will from time to time look at the earnings certain tilts themselves as an equal weighted composite so that we can actually look specifically at those 6 members and their contribution to the larger S&P 500 where appropriate. Before we do that, I wanted to remind everyone that it's Q3 earnings season and it's kicking into gear, and our weekly earnings trend report gives you the essential insights you need to stay on top of all the latest developments. We've literally just finished our latest report. You can get a free copy of it by clicking the link in the description below. In every issue, you'll find detailed analysis of earnings by sector and even subsector, as well as our expectations for upcoming quarter and the full year. Our Director of Research, Shiraz Mian, puts this all into context with his expert commentary. Advisor Tools subscribers have access to this report every week. We'll email you a free copy of our latest issue. Just click the link in the description below this video, and I will scroll down so you can kind of get an idea of the report. It's really good. I love tuning into this, especially for financial advisors or anyone in a client-facing role. If you need to know the ins and outs, what's going on in earnings season, really quickly without reading for hours and hours a day, this is your report. You'll absolutely look like a rock star anytime a client calls. All right, let's go ahead and jump into the research system and get underway. So what I have on the screen here is just a PE chart, PEF12M to be specific. And for today's webinar, I went ahead and put together a pitch book. I just called it SP500 Analysis. Anyone who wants to replicate this pitch book, just go ahead and get in touch with us. We'll help you put it together. It's very simple. Just starting off at the top, we're literally just going to work through some charts. I've looked at some of this stuff, and it's just absolutely amazing, and I wanted to share it with everyone today. Before we get started, though, I wanted to, again, baseline our methodology for our market-weighted composite algorithms just to show how accurate it is relative to the actual S&P 500 index. The reason this is important is the analysis that we're going to do isn't something that's going to be published by S&P, and it's not going to be something that you're going to be able to easily replicate in any other software. And so I want to show you how accurate this methodology is. So we have our S&P 500 market-weighted composite, and I want you to see how well it mirrors the actual index in terms of the PEF12M. We're going to be looking at valuations today. We're going to be looking at margins, and I just want everybody comfortable with this methodology. So you can see it pretty much as a mirror one-for-one in these movements. And so what we're going to do is we're going to move away from the index at this point, and we are going to go in here and put in the X tilts portfolio. So you can see how a bottom-up reconstruction of the S&P 500 minus the 6 macro ECP tilt names, when you remove those names and you literally reaggregate the S&P 500 as if those names never existed, in other words, reweight the entire benchmark, this is what you get. And if I do a right mouse click history, you'll see this is a 20-year trend. And you can see that it's literally a mirror up until the point we hit that 2013, 2014 timeframe. Recall that from prior webinars, this is about the same time that equity risk premium plunged. And so a lot of those tech names started commanding a higher PE multiple. And you can see that trajectory carry forward. So the S&P 500, the SP5M is going to be the one that mirrors the index itself. This is obviously going to contain those 6 macro tech names. And obviously the SP5M XT, X tilt is with it removed. So you can see obviously a much lower PE multiple than the S&P 500 currently trading. So let's take a look at how performance looks, okay? And we can go ahead and run this all the way back out to a 25-year. And what I wanted to show everyone here is just the importance of these ECP macro tilt names, these 6 mega cap tech stocks. And if you run this all the way back to a 25-year history, just keep your eyes on the blue line relative to the red line, as we'll kind of put this in motion. And we'll see the outperformance, not just from a 25-year perspective, but literally when we run through each of these time frames. So we'll go from a 25 to a 20. You can see on average, and I speak in terms of averages because when we look at composites, we're really looking at market-weighted averages. So these are going to be your market-weighted average stock in the S&P 500 returning 375%, whereas if you remove the 6 ECP mega cap tech names and you reweight the S&P 500 without those 6 names, remember those 6 names represent 23.5% of the S&P 500. So you get something very different. Only 251% on average is the price performance over the last 20 years versus 375.5 when you add those 6 names back in. So again, let's keep going with this. We'll just put it in motion. We'll go to a 15-year, and you can see that outperformance of almost 100%. Go to a 10-year. Okay, we continue that trend of outperformance. 5-year. This is how influential those 6 ECP mega cap tech names are to the S&P 500. Matter of fact, we just continue to put this in motion. You'll see the 3-year continues that outperformance. The 2-year continues the outperformance, 1 year, and year to date. So virtually every single time frame you choose, the influence of those ECP macro tech names cannot be ignored and they cannot be understated. Let's look at what's going on with earnings trends. So we'll take a look at earnings trends, and we'll do this a little bit differently. This is going to be your EPS estimate revisions. And this is something that I love to monitor from a macro perspective. I find it fascinating. And we'll start with the X tilts. And notice that for both the SP 500 and the S&P 500, when you remove the tilts, in other words, the X tilts, which is what we're looking at here, you'll see that the trend is up, right? We know we're in a recovery on the S&P 500. Even if we remove the macro tech names, we know we've got really good cyclical participation right now. And EPS estimate revisions are pretty much up across all sectors. And the interesting thing I want everyone to note here is the percentages, okay? So if we look at the December 2021 EPS estimate currently right now at 523, that is up 21.6% from the October 2020 read of 430. And so I just want you to pay attention to these numbers, 21.6 and 12 for FY2. And FY2 is going to be that December 2022 number of 569. That's up only 12%. When we add back mega cap tech, okay, and we go to the SP5M, I want you to see how these two numbers change. So we go from 21.6 to 12. Adding back mega cap tech, you can see the influence. And I think I just did X tech again, or X tilt, sorry. There we go. 24.5 and 14.6. So it's quite a bit larger revisions when you add the mega cap tech group back in. So again, we'll toggle it one more time. We'll go from 24.5 to 14.6, X tilt 21.6 all the way down to 12. Okay, so certainly a significance in the actual estimate revisions. Again, the 23.5% weight that those 6 stocks carry, contributing quite a bit to EPS estimate revisions over the last 12 months, even after the run up those names had in COVID. Okay, and again, you can see that by simply putting in the earnings certain tilt portfolio, which is going to be a composite of those 6 mega cap tech names. And you can see that they're up collectively 40.2% and 26%. So you can see if you weight that by about 25% where that contribution is coming from. It's substantial, okay? So we'll go back to our X tilts. Next thing I want to take a look at is some things going on in the income statement. The income statement analysis obviously leads me right into margins and other topics, but I always like to start here and just poke around at some of these profit lines, some of the operating type information. And you can see here that with X tilts, we've got something that is very cyclical looking. In other words, you would expect operating profit over the years to basically be on an upward trajectory, and we're not seeing that. Same thing with gross profit. It did tick up here in 08, and it's just been kind of flat. And it's interesting to take a look and see what happens if you put the S&P 500 up here, if that looks a little bit different. And you can see that when you add mega cap tech, you get a gross profit that trends up, okay, with not that cyclicality. And if we look at the operating line, you get something very similar, so nowhere near as cyclical, okay? So this brings us to our next view, which is margin analysis, right? Everyone knows how much I love this view. And what I want everyone to see is that even with the ECP macro tech names in here, again, we're looking at the S&P 500 right now, the SP5M composite ETF. I want everyone to see that at least we've been able to more or less flatline that gross margin number, but we've literally got gross margin sitting at 48%, operating margin sitting at about 22.5%, and net margin sitting at 18.33%. What I want everyone to pay attention to is this revenue trajectory of 8.18%. And when we go ahead and remove the ECP mega cap tech names, you can see that that revenue growth drops from 8.18 year over year. Again, this is a trailing 12-month, 1-year percent change. We're only at 2.37 if you remove mega cap tech. So that goes to show you tech's influence, or at least these 6 ECP mega cap tech names' influence on that revenue trend is substantial. I also want you to know how gross margins continue to trend down, okay? Whereas when you add back the ECP mega cap tech names, the margins are defended, okay? So ECP mega cap tech names doing a much better job at passing on cost of goods sold through in terms of price increases versus the remainder of the S&P 500. And we can see that when we compare the SP5M to the SP5M XT or XTilts. So right now we're looking at the S&P 500. We'll go ahead and remove the 6 ECP mega cap tech names now, and you'll see that that gross margin, in fact, is on a downward trend, okay? Operating margins, net margins, obviously those numbers are just a touch lower if you remove ECP mega cap tech names. So if I switch this back to S&P 500, you'll see those are 22.49, 18.33, and then go back to tech. And remove tech, sorry about that. It's a little confusing switching back and forth all the time. 18.32 and 13.97. Okay, so a substantial difference there in margins. Interestingly enough, we look at free cash flow margin, right? So this is going to basically just be free cash flow margin, and I'm going to go ahead and make this absolute. And right now I've got the SP5M XTilts relative to itself. So we'll go ahead and switch this, and I'll make this a 20-year chart. And you can see here that from a free cash flow margin perspective, when we take a look at the S&P 500, again, this would include your ECP mega cap tech names. If you strip out the mega cap tech group, you could see the difference here in these companies' ability to deliver free cash flow per unit of revenues is literally cut in half without that mega cap tech group. So free cash flow margin is literally sitting around 14% for the S&P 500 as a whole with tech, with mega cap tech. If you remove that, those ECP mega cap tech names, it literally gets cut in half, okay? So this is literally free cash flow divided by revenues. So free cash flow is literally going to be your operating cash flow plus your changes in property, plant, and equipment divided by your revenue line. And this is substantial. And if you take a look at what earning certain tilt names do just in core, you can see how substantial this is. Here's your earning certain tilt portfolio sitting at basically a 20% contribution on free cash flow margin, whereas XTilt is 7. And if you put the S&P 500 in here, okay, you can see that's 14. So the tilts, again, having that 23.5% weight, even though it's an equal weight, right, you can get a sense for the magnitude of the contribution of free cash flow per unit of revenues to the S&P 500. It's substantial. All right, so we'll go ahead and move on to R&D as a percent of sales. And to do this one justice, I'm going to go ahead and move this back to the S&P 500 minus the tilts, and we'll look at this relative to the S&P 500. And what you're going to see is that it's basically the S&P 500 that is delivering your innovation, right? If you strip out those 6 ECP macro tilt names, R&D as a percent of sales just absolutely collapses. So what you end up getting when you add back those 6 ECP mega cap tech names is something substantial in terms of their R&D spend as a percent of sales. So you can see we're deriving just an absolute ton of innovation out of these 6 stocks. And again, we can put the ECP tilts up here as their own composite, and you can see that they're roughly 3 times the S&P 500 in core. And if we were to make that in relative to XTilts, you can see that it's orders of magnitude less. You could say it's basically 4 times more R&D spend as a percentage sales, minus the S&P 500 if you remove those same 6 names. So it's substantial amount of spend and substantial amount of innovation that these 6 macro ECP tech names contribute to the broader market. When we start looking at the capital efficiency ratios, this is where things begin to get interesting. And I'm going to go ahead and switch this around. I'm going to put the XTilts over here and put the S&P 500 here. And we'll move on to our next view, which is going to be the return on assets. And this is where things get, obviously, like I said, really interesting. It's not just a 1 or 2 quarter anomaly here with these macro tech names. These ECP macro tech names, these 6 stocks, really do contribute a lot in terms of capital efficiency, especially when we take a look at that return on asset number. It's just huge. It's not quite 2 times, but it might just as well be. The trend is just that much more solid on the upshoot out of COVID as well. So we take a look at return on capital. Again, the ability to compound returns on its capital structure, almost 2 times as well here. And this is relative to the S&P 500 minus those 6 ECP mega cap tech names. Okay. Return on equity, again, just shy of 2 times more efficient at returning earnings to common equity shareholders. It's just absolutely incredible. 26.15% versus 15.95%. Okay. And again, I have a repeat of the free cash flow return on investment. What I wanted to show everyone here was that free cash flow return on investment for that core tech group is just absolutely incredible. Here is the ECP tech group. So this is the 6 ECP mega cap tech names. And this is actually relative to the S&P 500. So you can see that that's actually 3 times the amount of free cash flow return on investment. And what I want to show you is that if you actually switch this over here to the X tilts, so we're getting a real apples to apples comparison, right? Because this ECP tilt portfolio equal weighted is going to be those 6 names. And then the SP5M XT is going to be the S&P 500 rebalanced without the 6 names. I mean, this is literally, you could call it 7.5 times the amount of free cash flow return on investment. So a substantial contribution to the broader market. These 6 macro ECP tilt names contribute. So the key here is that with all this negative press surrounding the mega cap technology group, they are still the group delivering the bulk of the technological innovation as measured by that R&D as a percent of sales. Right? Let's not forget this when you see and read in the Wall Street Journal and on CNBC, all this, the bad press these companies get, right? These are the companies that are delivering your technological innovation. In prior webinars, I've always said, including in the semiconductor space, remember that all of these companies are vertically integrating, and they are the tail wagging the dog of the semiconductor industry as well, okay? Not only are they driving all the technological innovation, but this group remains the primary driver of the S&P 500 Composite ETF earnings growth. Again, remember, we looked at that EPS estimate revision trend. It's just substantial, right? For the earnings certain stocks themselves, these companies not only benefited through COVID, but keep in mind, these companies peaked, many of them, last year during the end of September, October timeframe. They haven't done much in terms of performance since as a group. Collectively, their earnings are up 40% and 26%, right? So these companies, these 6 stocks with this 23.5% weight are the primary drivers of EPS estimate revision trend and earnings growth. Same thing with revenue growth, profit margins, free cash flow as a percent of revenue, and drivers of all capital efficiency for the entire S&P 500 Composite ETF. So my message with this webinar is, let's never take our eyes off this group, and we never want to take this group for granted. That's about it for this week. If you found this video helpful, please hit the like button below and be sure to subscribe for future videos. If you have any questions or ideas for future videos, please leave a comment below or email me at tnyland@zacks.com. You can also follow me on social media. I'm on LinkedIn and I'm on Twitter at Tim Nyland. If you're interested in getting started with Advisor Tools or ZRS, or if you're looking to upgrade your current subscription, please contact our world-class support at advisortools@zacks.com and ZRS@zacks.com. Thank you all for watching, and I'll talk to you all next week.